What's up everyone, it's Caddy with Money Vesting. So about 3 days ago, I posted a video talking about one potential bank that is making some headlines of a concern in the contagion with the banking crisis. And that's what we're going to discuss in this video because this bank stock continues to drop here. And the CDS, which is a credit default swaps, which are bets against the bank or pretty much expecting the bank is going to fail, have skyrocketed as we speak. They have gone up substantially as investors are more and more concerned about a potential failure of this bank. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. 16% annual discount available till the end of this month, and you can get access to all the buy and sell alerts, options alerts, trade ideas, and of course access to a lot of other private videos, lectures, and tutorials as well, and all the benefits. So links going to be down below. So the bank in question is going to be none other than the German giant, and that's going to be Deutsche Bank. On the day, you'll notice it was down a little bit over 6%. This month, in March, it is down over 22%. And this was the video that I did about 3 days ago talking about CoCo bonds, which was, again, AT1, additional Tier 1 bonds for Credit Suisse, which were completely wiped out and vaporized to zero. And we also talked about towards the end of the video, if you go to like the 7:50-minute mark, you'll notice that we talked about Deutsche Bank when at the time it was trading at around $9.89, close to $9.90. And right now, of course, dropping pretty heavily. And it never really recovered from the great financial crisis of 07-08. It dropped a little bit over 85%, recovered back higher. But since then, it has been on a very, very significant trajectory lower, making lower highs. Something that we're all aware of seeing, something very similar to Credit Suisse. As you can see, it never really recovered from its great financial crisis. Was this on a consistent path of making lower highs and lower lows, and then finally just plummeted 71%. So keep a close eye. Again, not saying this is going to be the next bank or we need to be like, super concerned, but definitely keep a close eye because we did have the credit default swap prices jump in a violent move while share price plunge as stress in the banking system keeps rising following the Fed rate hike. And this is as of today, just a few hours ago. You'll notice that Deutsche Bank's 5-year credit default swaps are going parabolic, up from 415 basis points to 525, up by 110 or 1.1% just today alone. And these are levels that we haven't really quite seen if you go back to as far as 2019, 2020, and even as far as the great financial crisis. We haven't really seen these CDS jumps here in that time. This is just the Deutsche Bank subordinated credit default swap, senior preferred credit default swap, and senior non-preferred credit default swap. Subordinated, I understand it's going to be much, much higher, trading at 510 basis points because that's the AT1 bonds and that's the additional tier bonds. And looking, so the thing that the theory really is that since Credit Suisse went down and the AT1 tier bonds, additional tier ones, and again, which was discussed in this video going over the CoCo bonds, they're called contingent convertibles. That's why it's called CoCo. Since they were not shifted over to preferred equity as it should have because they're convertible in nature, they were completely wiped out or they were wrote down to zero, and bondholders didn't really get anything back, is one of the reasons why we are potentially seeing the credit default swaps, more specifically with subordinated debt that Deutsche Bank issues, rise, and that's going parabolic because the failure of that is substantially higher as opposed to senior bank senior preferred and non-preferred bonds as well. But nonetheless, we're seeing all three credit default swaps go higher in expectations that if the bank fails, it's not going to be able to meet up with its obligations, and it's possible that especially the AT1 tier bonds are written down to zero at the moment. Now, I did some research on the bank itself. There's been some reports, there's been some papers from the past that Deutsche Bank has created trillions in dollars worth of derivatives, but its exposure is actually a fraction of that. But the total notional value of the derivatives that it has created is over 48 trillion euros, and the positive market value $364 billion, and the net market value of 20 billion euros. So there was some, reports somewhere. Again, this is a research from 2016, and it doesn't necessarily mean, the bank these are like things that happen over several decades, right? Credit Suisse it wasn't this interest rate hike or it wasn't this 2022 event that really pushed Credit Suisse to fail. No, it was decades worth of problems. It was decades worth of scandals and frauds and, just kind of not being able to manage risk, and poor management led to this final, nail in the coffin where it's now, trading for cents on the dollar and really getting acquired by UBS. So it's not really that one event that leads to these big implosions, but instead it is really this years and decades long of mismanagement and, improper practices, malpractices, and not being able to manage risk that leads to this final day of reckoning for these banks. That's why I think it's important for us to really understand what is Deutsche Bank going through, what it has gone through, what type of assets and derivatives is it sitting on, and just because the risk is coming back in right now doesn't mean that it's just a matter of 2022 or 2023. It can be several things that are kind of building up on each other. So this is a paper from 2016. So while the derivatives pile may not be as large as the headline numbers suggest, Deutsche Bank is sitting on a pile of assets that are hard to value, and some investors don't need much excuse to sell its stock. And that unknown is contained in the level 3 assets it holds, or those whose value is difficult to determine, such as complex derivatives and distressed debt. Deutsche Bank has more level 3 assets compared with its common equity tier 1 ratio. So CET1 ratio, that's the capital ratio requirements that a lot of banks have, and a measure of financial strength pretty much for financial institutions. Its level 3 assets are estimated as being valued at 72% of its tier 1 assets, according to JP Morgan, and that compares with 38% average for 12 regional banks. So they definitely do have a lot of derivative assets that are, very prone to fluctuations of market conditions. And the difference is in part because of derivatives, right? At the end of last year, this is again 2016, by the way, Deutsche Bank was sitting on a pool of $10.2 billion of illiquid derivatives, according to the bank's own valuations, compared to $8 billion of Barclays and $5.9 billion of Goldman Sachs. So almost twice as much of Goldman Sachs in illiquid, right? They're not liquid assets for the company, right? So if there's a run, if there is deposits needed, the company is not going to be able to, convert them from illiquid to actual liquid cash in order to meet the obligations of their depositors. But instead, these are illiquid derivatives. Now, because of these illiquid assets are harder to evaluate, that stokes concern when a bank is being squeezed in the market, in other words, is being run on. And David Hendler of advisory firm Vilar Risk Advisors said that the bank is developing a, quote, Lehman-like profile, and the level 3 holdings pose a considerable risk to Deutsche Bank's capital base given the lender's low earnings. So, keep a close eye on Deutsche Bank, I guess. Definitely pay attention to it and see what's going on. I will continue to kind of update you guys as I learn more about it, as there's more information that comes out. But, this month it's down 22% on the day, down 6%. Credit default swaps are skyrocketing for this company. And Genevieve also tweeted earlier that, good morning, everyone. Fed hiking rates will cause more losses on bank balance sheets. Unrealized losses are $620 billion. I think it's a lot more. Again, from that research paper we studied, it's closer to $2 trillion and not $620 billion. That's up from $8 billion a year ago. And Yellen said that FDIC will not guarantee all deposits. Meanwhile, equity and bondholders of regional banks are getting wiped out overnight if there's a bank run. We had 5 bank fails in 10 days. This doesn't end well. So keep a close eye on Deutsche. Keep a close eye on regional banks, of course, because we did have a lot of regional banks also continue to drop. I mean, Comerica was down over 8.58%. PacWest was also down, I think, a little bit over 8 or 9% here, 8.5% also for PacWest. So we are continuing to see regional outflows because of the comments from Janet Yellen, and then some of the bigger banks, because Deutsche Bank is an SIB. It's a systemically important bank in Germany, one of the biggest banks in Germany. So it's going to definitely be a much bigger bank to fall if it happens. So keep a close eye on that. I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Let me know your thoughts down in the comment section below. It's always happy investing. I'll see you all in the next video.